Thanks, Steve. Thanks for the introduction and welcome, everybody. Thanks for joining us today. As Steve mentioned, I'm Richie Ragel, the co-founder of Milk Chocolate Property. So today we're going to talk about how Milk Chocolate supports Australian expats purchasing family homes and investment properties back home in Australia. We're going to do a bit of a current around the grounds on the Australian property market. So getting in deep with regards to what we're seeing on the ground. It's a report written by our economist, Kevin. So that's going to be really interesting. And also a little bit about our digital platform that takes away the complexity of buying property from afar. And also, guys, just a standard disclaimer that any advice today is in general in nature, and always just consult your professional services provider before making any decisions. So for those who are not aware of Milk Chocolate, and what we do, so essentially we offer a complete service encompassing research, planning, buying, building, and management. Milk Chocolate takes care of every aspect of your property journey on your behalf. We're nationally licensed and purchase properties in all states and territories, excluding the Northern Territory. A little bit about myself. So I've been purchasing, renovating, and selling property since 2006. So coming up to 2 decades now. So co-founder of Milk Chocolate, my role in the business is that I oversee the data and analytics team, the purchasing and construction teams. I've also personally assisted more than 350 clients to create, implement, and execute their property goals. Since 2016, I've also personally helped about 120 of our clients purchase properties. So have been doing this for a little while now. So hopefully it would sound like I know what I'm talking about because, we've been doing it since 2006, but assisting our clients since 2016. A little bit about the team before we get into it. So it's not just me. My co-founder is Michael Cleary as well, but we've also assembled a team of world-class subject matter experts that span across all major aspects of the property journey. So as you can see there's 4 pillars, and that's 4 pillars to our business. So data and analytics and economics, purchasing and due diligence, design and project management, and property management. So that team is composed of economists, valuers, qualified property investment advisors, data scientists, real estate agents, project managers, interior designers, property managers, to name a few. So across those verticals, we assist our clients to execute across that whole property journey. The primary focus of the business is that we purchase properties, but that's assisted by those additional pillars that execute that journey from start to finish. We work with Aussie expats looking to invest or buy properties back home in Australia. So just a little bit about the results before we jump into what's happening in the Australian property market. So the reason why we wanted to put this here is because we're actually really proud of the results since inception in 2016. So on average, our clients have achieved about 13.63% growth year on year since 2016, with an average yield of about 3.39%. So that goes back to the subject matter expertise and having those experts in data, economics, but also in real estate, construction, and property management to help us achieve those results for our clients. And what's really important to understand is that is over a period of time where we've seen multiple property cycles. So there's been plenty of ups and downs since that particular period in time, but it's really important to understand the fundamentals of the real estate property market, but also understanding what the data and analytics are telling us and where we should be purchasing in each of those particular markets at what particular point in time as well. So I'm assuming this is what a lot of you are here to hear is what's happening in the Australian property market trends. So our senior economist, who's Dr. Kevin Hong, put together these amazing insights. So Kevin has a PhD in economics, econometrics and statistics, and is responsible for our economic and data expertise. So what we're going to do today, guys, is we're firstly going to take a look around the grounds and understand what's happening in the Aussie property market. We'll then focus on the drivers that we should be monitoring moving forward, followed by a high-level assessment of the current property cycle and our thoughts on each of those particular markets as well. So jumping straight into it. So the current upswing in housing values continues to show strength. So values increased by 0.4% in August 2024, and marking a 20th consecutive month of combined growth since January 2023. So we're on a significant period of upswing still at this particular point in time. However, performance varies across each of those particular cities. So Perth, Adelaide, and Brisbane, as you can see, are the top performers with year-on-year growth rates of 21%, 12%, and 11% respectively over the past 12 months. In contrast, growth has been slower in Hobart at -2%, Melbourne at -3.2%, and Canberra at -3.3%, and Darwin, of course, at -4.3%. So that's generally driven by weaker market confidence and an influx of brand new housing supply. And that's particularly in the Melbourne market at this particular point in time. So despite these differences, it's essential to keep a broader view about the fundamentals in each capital city. So strong performance in some cities may not last in coming years, while underperforming cities could offer better opportunities to enter into the market and benefit from future growth phases. So we're currently moving into a buyer's market with vendor discounting remaining steady at -3.7%, reflecting market conditions and a vendor's requirement to negotiate to secure a deal. So that's really important to note and understand. So important to understand what the data is telling us, but what we're seeing on the ground is reflected in that particular figure as well, is that now vendors' expectations need to realign with where buyers are at, because buyers are now showing a little bit more patience and happy to walk away from deals if the vendors aren't willing to come down in their price point. So we're certainly starting to see that shift, which is great news from a buying perspective. From a new listings perspective, so new listings totaled about 42,000, so that's 2.1% higher than the same time last year and 8.2% above the historic 5-year average. And it's the highest level of new listings in the first month of spring since 2021. So obviously that's correlating with supply. So increase in supply may also see some of those markets starting to cool, in particular those markets that have performed well over the last 3 to 4 years. So we've seen total listings rising to about 145,000 in the 4 weeks to the 6th of October 2024. So Sydney at 3.7%, Brisbane 12.1%, and Perth at 9.4% have all seen stronger flow of new listings over the 4 weeks to the 6th of October compared to the same time last year. Total listings in Brisbane are now 4.2% higher than this time last year, while advertised supply in Sydney and Melbourne is 6.9% and 7.9% higher, respectively. So that's but also this is dependent on where you are looking and which particular markets that you're focusing on. In some of the markets that we're currently buying in North Brisbane and some of those sub-regional markets, supply is still pretty tight, especially when you're looking at the quality of the supply that's coming onto the market. So it's important to note supply may be increasing, but it's the quality of that stock that's coming onto the market. We're still dismissing a lot of those properties because they're not meeting the real estate fundamentals that we set as buyers agents to purchase great investment properties for our clients. From a rental perspective, national rent values increased by 7.8% in 12 months leading up to July 2024. So that's roughly double the decade-long average trend of 3%. So I'm sure you're all aware of that, but rents have increased significantly. That's due to the population growth in all major capital cities. This surge is occurring amidst supply constraints and rapid population growth, although the rental market has shown signs of easing in recent months and vacancy rates remain tight across the country. So given current challenges in the construction sector, such as rising costs and labour shortages, expected to take years for the rental market to return to that normal vacancy rate of 2 to 3%. And it certainly feels like it's been a period of time now since we have seen vacancy rates sit at that 2 to 3% value. It was only about 12 to 18 months ago when most markets are sitting below 1%. So we're starting to see that loosen, but it's still well below what we've seen historically. During this adjustment period, low vacancy rates and higher rental yields are likely to continue, driving property prices upwards in 2024 and 2025 beyond. And it's also going to see a lot more appetite from investors as well, who are still chasing those higher rents and obviously accompanied by those higher yields as well. So moving on to market drivers and what to monitor moving forward. So really, really important to understand what are the major influences that could affect pricing both negatively and positively. And Dr. Kevin has identified the following key drivers to monitor moving forward, confirming that these have the strongest correlation to positive and negative market movements over the next few years. So starting with population growth, so Australia's long-term average growth rate was 1.3%, but it surged to 2% in the past couple of years. That's compared to 0.3% in European countries, 0.6% in the US, and 0.6% across the OECD countries. High population growth places significant pressure on housing and infrastructure, pushing up price increases in the major capital cities across the country. And a major component of this population increase has been net overseas migration, which rose from a net inflow of 69,000 people in the 1990s to 200,000 in the 2000s and surged to 450,000 in 2022 and 2023. So it just shows you the significant growth that we're seeing here in Australia. Looking ahead, our projections indicate that the Australian population will grow by approximately 1.5 million people, which is actually the equivalent to the size of Adelaide, and that's within the next 3 years. So there's still a significant amount of growth driven by population coming to Australia. All of those people are going to need places to live, either from renting or from a purchasing perspective. So it's easy to see and understand why we think the market's still going to show some strong demand, which is going to keep price appreciations positive over the next couple of years across the major capital cities. Housing supply, so dwelling approvals and dwelling commencement. So given the robust housing demand and accumulated unmet need over many years, we're focused on housing supply, which is determined by approvals and commencements. So two different things here. So firstly, when we're looking at approvals, the ABS data release shows that 160,000 dwellings were approved in the 12 months leading up to June 2024, which is a significant drop from the peak of 230,000 dwellings approvals in 2018. So lower approval rates will lead to fewer commencements and eventually completions in the medium term, contributing to tight supply, especially in major capital cities with significant sustained population growth. So even if you combine those two things, when you're looking at population growth and the lack of approvals, you can see the stress that's going to continue to apply to this particular marketplace. Building commencements. So according to the latest ABS data, 160,000 dwellings were commenced in the 12 months leading up to March 2024, a decrease of 10% compared to the same period the previous year and about 20% below the long-term average of approximately 200,000 dwellings per year. So it represents the lowest figure since 2013. And that's coinciding with the cost of labour, cost of materials as well. And so this is something significantly that we just need to be aware of and monitor that. Obviously, we are starting to see governments, a lot of stimulus packages relating to releasing of new greenfield estates and incentivising builders to construct and build. And also, hopefully, we'll start to see some correlation back to council approvals and some, I suppose, state and federal government coming into those conversations to help push along approvals and commencements so we can get more buildings and housing built and developed for that growing population that we're going to see across the nation. When we're looking at inflation, the Reserve Bank of Australia aims to maintain inflation within its target range of 2 to 3%. So I'm sure you're all aware of that. We've been talking about it for a little while now. We know that it ensures a stable macroeconomic conditions, full employment, balanced economy. Inflation has significantly declined from its peak. It's about 7.8% in December 2022. The rise in interest rates has played a key role, as we know, in cooling the economy by bringing aggregate demand and supply closer to equilibrium. Inflation has been trending downward, reaching approximately 3.5% over the 12 months leading up to July 2024. So getting closer to that point where we're going to see a level of comfort between that 2 to 3%. I'm sure the guys will talk a little bit more about this in more detail, in particular to interest rates and what we expect to see in the next 12 months from that perspective. Lending conditions, so housing loan commitments are a key driver for housing prices with an upward trend in these commitments, closely linked to increased buyer activity and rising property values. So recent data from the ABS leading indicators released on the 8th of July shows a consistent upward trend in total housing loan commitments, which grew from 22.8 billion in February 2023 to 29.5 billion in June 2024. So it's a significant upswing in that respect. Investors, as we know, are crucial to the housing market, and this rise in investor loan commitments indicates growing confidence in the property market's prospects. As investors typically impact market dynamics, their increased participation often leads to higher market activity, which leads to rising property prices. So nationally, the share of investor loan commitments has steadily increased over the past 16 months, accounting for about 38.6% of new mortgages as of September 2024, and that's the highest since 2017. So a couple of key things there that we're pointing out, which are all talking towards a positive appreciation in prices over the next at least 12 to 24 months. Finally, interest rates, which I know the guys will talk about. The current interest rates, the cash rate sits at 4.35%, and that's unchanged since November 2023. So we're coming up to nearly 12 months of those rates remaining on hold. The prospect of future interest rate cuts hinges largely on the inflation trend over the coming months. Major banks, which I'm sure the guys might talk to, which monitor real-time spending patterns of consumers and businesses, have begun reducing fixed rate mortgage rates, and the implications of potential rate cuts are going to be significant. So I'm sure what's going to happen in the next 6 to 12 months, and I know the guys will talk about this, but they're starting to see some of those indicators that it might lead towards an interest rate drop in 2025, which we know is going to provide a lot of confidence back into that property market, especially again with investors. So there are some of the market drivers to monitor moving forward. When we're looking at the future forecasts, sorry, I've just jumped ahead. So property cycle duration analysis is what I wanted to talk about. And we'll share this with you guys. I appreciate there's a fair bit of information on this particular slide and some of the other slides as well, so you can take a deeper dive into it once we share it with you. But a couple of highlights that we just wanted to point out in this is that Sydney is on par now with its average growth cycle, which implies that we expect to see slower growth rates. However, investors are still going to be looking for value in this particular market and target affordable segments of the market where prices are sub 1.5 mil, such as the south and northwest growth regions where large infrastructure projects are being implemented. What we can also see is Melbourne's recent declines are in line with historical down cycles, indicating that an imminent growth period is upon us. And sort of what we know as well from Melbourne's recent declines is the fact that it was probably more induced by those forced lockdowns, 14 of which were in 2020 and 2021, which put a significant stop on that particular market from any growth. And what we did see was that, some of those markets, capital cities around Australia since 2021 grew by about 50 to 60%. Melbourne was at about 15 to 16%. So a significant effect on that particular market. We also saw a lot of people moving interstate, in particular to southeast Queensland and further north. And so we'll likely see some of those prices starting to appreciate in Melbourne's capital city within the next 12 to 24 months. Based on what we're probably seeing at this stage is in terms of affordability in comparison to some of the other capital cities across Australia. We can also see that Brisbane still has some room to move, while Perth and Adelaide markets are currently outperforming the historical growth cycles. It's likely due, though, to the affordable nature in comparison to the other capital cities, which comes also from a low cost base, which is accentuating a longer growth run as investors continue to see value in those particular markets. And also yields are playing a factor in those particular markets as well. And the other key market to monitor is Canberra, where the city is projected to move to a recovering and rising phase after recent sluggish periods. So that's a couple of key things to point out in that particular slide. Again, looking at future forecasts across those major capital cities, and we'll talk a little bit about regional markets as well. But when we're looking at each of those capital cities, when we're starting with Sydney, it's the most populous city in Australia. As we know, the population of 5.4 million, strong growth rate of 2.8% from a population perspective. City boasts a diverse and high-performing economy, and there are no signs of oversupply with a stable housing supply of 30,000 dwellings. However, Sydney's medium house price is among the highest in the country. Well, it is at 1.35, which is 550,000 more than Melbourne's medium house price at this particular point in time. Given these factors, we anticipate that house prices in Sydney will continue to rise due to strong demand, though slower than in recent years. Due to affordability constraints, more affordable segments in the outer rings, which I just touched on, such as the southwest and northwest regions with good connectivity to major CBDs, such as Sydney and Parramatta, will likely see strong performance. At the same time, prices in premium areas are predicted to increase at slower rates moving forward. It's also important to point out that Sydney is generally an owner-occupier-led market. And what we mean by that is you generally got buyers in that market who are primarily focused on purchasing their family home as opposed to an investment property. Therefore, they're paying a little bit more of an emotional premium to acquire that particular asset for their family home and their principal place of residence. That's generally why you see that particular market growing at those particular strengths, and also why that median price is so high, correlating with obviously the economy and work opportunities in this particular city. But we'll definitely see the pace of growth, which we are already seeing at this particular point in time, continue to slow down. But we do believe it will still increase, although at a slower rate. Now, Melbourne, As I touched on, Melbourne house prices have been experiencing negative growth rates since December 2022, although there have been signs of recovery in recent months. House prices in other capital cities have surged 50 to 60%, while Melbourne has lagged behind around the 15%. So the price gap between Sydney and Melbourne is now at its widest in many years. So as I touched on, 1.35 in Sydney compared to Melbourne's 810. However, Melbourne's large population, strong growth rate, diverse economy, and under-trended supply are expected to drive prices up in 2024 and 2025 and beyond. Additionally, house prices in second-tier cities like Adelaide and Perth are catching up to Melbourne, and Brisbane has recently overtaken Melbourne. This highlights the good value of Melbourne's property prices, and we believe that Melbourne's house prices will move into a new growth cycle with stronger growth expected in 12 to 18 months. Brisbane, over the past years, Brisbane has been a favourite destination among investors, with house prices increasing by circa 50% since 2021, 2022. This surge can be attributed in part to the city's affordable prices and attractive rental yields, which have drawn in many investors seeking to navigate high interest rates. Despite the significant price increase, Brisbane remains relatively affordable compared to Sydney, and the city's strong fundamentals, including large and growing population, diverse economy. Also, the major infrastructure projects in preparation for the Olympics further support its housing market. And additionally, a severe supply shortage. Current listings are about 50% lower than pre-2020 levels. But as we touched on, we're starting to see some of that supply increasing in more recent months. We do forecast further growth from Brisbane in the next 12 months before a level of stabilised growth thereafter as more supply comes on the market and affordability becomes a more pressing issue in the coming years for this city. We're also buoyant on some of those regions, sub-regions just outside of the Brisbane CBD that are still within a commutable distance as well, when you're looking and taking into that consideration the ripple effects of price appreciation in the major CBD. Adelaide, once considered the sleeping city, Adelaide has certainly emerged as one of the country's hotspots, with house prices increasing by 60% from 2021. Adelaide's transformed a more diverse economy, driven by sectors such as high technology, shipbuilding, significant infrastructure projects, such as that north-south corridor, have also enhanced its appeal as well. So additionally, Adelaide offers rental yields that can be up to twice as high as those in Sydney and Melbourne, and a severe undersupply with only 7,500 current listings compared to 17,000 pre-2020 has also contributed to the city's strong price growth in 2024 and 2025 and beyond. We're certainly anticipating similar conditions of growth and stability in this market like we do in Brisbane. Moving on to Perth, the economy now is more diverse, although still reliant on the mining sector as its primary economy. It's before the global financial crisis, it was certainly dominated by the mining economy, which had some key risk for us when a city is driven or a market is driven by one key economic driver. But population of 2.3 million now and a growth rate of 3.6% over the past 12 months, which is actually the highest in the country. It's continuing to thrive. So additionally, current listings stand at about 12,000 compared to 25,000 pre-2020, indicating a severe undersupply still. We believe that house prices in Perth will continue to perform strongly in 2024 and 2025, with growth of 13 to 15% before returning to historical growth rates thereafter. Also, just important actually just to touch on some of the reasons for those low supply rates is because people are unwilling to transact in a similar market where that's still quite buoyant, because it's all well and good to sell your property for a high value, but you still actually need to go out and purchase another property in that same particular market in the same conditions. And so that's somewhat causing people and vendors to negate the need to sell at this particular point in time, because it's going to take time, and it's also going to be quite tricky for them to be purchasing another asset in that same particular market unless there's favourable settlement conditions to allow enough time for them to go out and source, buy and settle on those properties. So that's common, in particular across those key markets that have shown the strongest growth in the last 12 months, Perth, Adelaide and Brisbane. So from our point of view, we believe Perth will continue to perform strongly in the next 12 to 18 months, and strong rates around 13 to 15% before it returns to historical growth rates thereafter. So still a little bit of gas left in that particular market, but it is tricky purchasing conditions. Canberra, house prices are expected to enter early stages of recovery in 2024, 2025. The nation's capital has struggled to establish a robust recovery, and likely to follow a slow growth trajectory still. So current data shows that the number of listings has stabilised at 4,000. The economy remains heavily dependent on government employment at a time when AI and digitisation could potentially weaken the strength of the labour market. We believe that house price in Canberra will increase by about 0 to 4%, 2024 and 2025, followed by growth of about 5 to 6% thereafter. Hobart, small population, 250,000, negative growth rate over the past 12 months reflects a weak overall economic conditions and housing demand. Although the number of listings is decreasing, demand remains insufficient to drive significant price increases. Recent trends suggest that the Hobart market is entering a recovery phase, but predicted growth rates between 0 and 2%, and then about 3% circa thereafter. Hobart has come off a significant run, generally probably given the low entry rate in that particular market. However, there's some concerns around sort of the population and the makeup and the dynamic of the population in that particular market. And in Tasmania, where you've got a lot of millennials completing their schooling or university, moving to the mainland for work opportunities, and you're getting a lot of baby boomers moving into that particular state for retirement. So that it's representing a bit of a weaker economy at this particular point in time. Darwin, we don't invest in the Darwin market. It's too small for us. However, it's got a low growth rate from a population perspective. It's quite a transient population, and it has minimal economic drivers. From our perspective, it has been performing not too well at this particular point in time. And from what Kevin's suggesting is that we don't believe it's going to see any significant growth. Investors are seeing value from a yield perspective, has some of the strongest yields, or does have the strongest yields across the country from a housing perspective. So that is certainly an option if you're looking for focusing just on yields. There's potentially some options in that particular market that you could consider. Separately, regional house and unit prices are expected to experience moderate growth in 2024 and 2025 beyond, though the outlook varies state by state due to differing demand and supply factors influencing the market. Many people who move to regional towns are returning to larger cities due to weaker labour markets and increased in-office requirements mandated by many of the bigger and smaller firms. This will weaken housing demand and dampen the price growth potentially in regional areas that are far from major capital cities. We believe, however, regional areas, especially those close to metropolitan centres, such as your Ballarats and Geelongs, Wollongong, Sunshine Coast, Toowoomba, Ipswich, for instance, in Queensland, remain attractive to home buyers who have been priced out of city markets but still want proximity to urban amenities. And as a result, these regions are likely to continue seeing strong demand from these segments of the population. So guys, that's a bit of an around the grounds from a property perspective, what's happening. Again, as I touched on, we'll share this with everyone afterwards, so you can take a bit of a deeper dive into that particular information. But just quickly, I know I'm probably running out of time, but just on our digital platform, so we understand that purchasing property from afar can feel daunting. The process can be seen as archaic and multiple stakeholders and a lot of paperwork. So along with our incredible team, the process is managed on a digital platform, providing education, building trust, and most importantly, a streamlined process. So it's been crafted in-house from our subject matter experts. We have a team of engineers who have been building this. It's AI mobile optimized and allows you to track every aspect of the property purchasing and owning experience. And as you can see on this next particular slide, the product allows you to track that journey from a game plan perspective. So bespoke game plans where we created personalized plans that help you achieve your desired property outcomes, moving through to data-driven recommendations. So platform will pair the right location to the output of your game plan, providing tailored recommendations for regions, suburbs, and also properties based on your preferences and goals. It's an end-to-end service. At Milk Chocolate, we handle that whole aspect of the property buying journey, from sourcing and appraising properties to managing negotiations and settlement. And of course, ongoing property management. So once the purchase is complete, if you're not moving straight in, the platform continues to support you with property management, including portfolio management, maintenance plans, and renovation projects. So guys, as you can see, if you need help, obviously we can do this with you. Our details will be left behind, and you can obviously get in touch with us if you have any questions or if you'd like to find out more about how we go about it. But I'm going to wrap up now because I know the